There are three topics we will be talking about tonight. First will be how the tax bracket works. This is important because the tax brackets is foundational to our US tax code. And if you read, you will see that the tax code is not brief. There's thousands of pages that make up the tax code, and these are going through constant changes year after year. Secondly, we'll talk about standard and itemized deductions. And then last, we will talk about credits and deductions. These all are really foundational to understanding how your taxes work and how you will be impacted by US taxes. Once we get through with our presentation, I hope you have a clear understanding of how tax brackets work, how standardized and itemized deductions work, and how you can take advantage of these to benefit with your tax refund. We will look closely and break down what credits look like. We have two different types, and then also deductions. I will also show you two examples. These are very common examples. Think of taxes like a car. Most of us have cars, but not all of us can fix cars. Nowadays, cars are a lot more complicated than they used to be. So we usually rely on a mechanic that we trust to take care of our cars and fix any issues that come up. If a car is simple and you understand, you can take care of it yourself. We do know how to take care of basic maintenance with our car, changing oils, filling up with fuel. Now, suppose you have another car or a truck, an SUV, we can imagine that things would get a little bit complicated. And that's the same with property and finances. Let's say if you have a business where you're running a farm. Let's say it's a Schedule C, E, or F. This is really complicated information that has a lot of tax benefits involved that we can take advantage of. To understand it completely, we need to start off with our basic information of the US tax code. We also will talk about deductions and credits in different tax brackets.
So you see the slide for the tax brackets here. At the top is 10%, and it goes down to 37%. And it also shows your income brackets. And there are different types of exemptions that can be applied there. For the deaf community, most of them fit into one of those first three brackets. Probably the 10% is where most people fit. And you see your income levels there, that for a single, it's up to $10,275, and married up to $20,500. And then you can see how the tax brackets change when you have an increase in your income. And a simple change in the minimum income can put you into the next bracket from, say, 12 to 22%, which is a drastic increase in the amount of taxes that you could be paying. part of going through your tax system is to figure out how to reduce the bite that your taxes can take out of your income, how to reduce how much tax you actually owe so that it hurts less. We'll go on to the next slide. So again, most of you are probably in the 12% bracket, right? Which is going to be an income level of, say, or your tax bill would be for 40,000 would then be 4,800. But if you get a raise, that pushes you into that 22% bracket, which increases your taxes to 9,240. And you think, whoa, that's a lot of an increase. The tax code that we follow is referred to as the progressive tax code, which means the more income you have, the more tax you pay. If you earn $40,000, for example, you have a certain percentage of it that is not taxed. And then as you earn more, that tax percentage goes up. Some people suggest having a flat tax rate, which means that everyone would pay the same percentage. But we follow the progressive tax system, which means the more you earn, the higher the percentage is that you pay. If you see there's 22%, 20 or 22, 24, etc. And here on this diagram, you see there's the 0%, which has your itemized and your standard deductions being equal. And we'll talk about those in the near future here, and the difference between a standard and an itemized deduction. The next bracket pays 10%, which means you've earned more, and everything over that 0% threshold has the 10% payment. Then if you earn more than that, you get to the 12%. Once you hit that limit, everything over that earns 12%. So each layer builds on the layer that came before for the amount of tax that you will be paying. The one thing I want to emphasize here is that we do follow this progressive system. And so each percentage of tax paid is based on what has come before as far as the increase in income goes. So again, we're going to use our example of $40,000 income. If you think about that progressive tax system that I was just describing, you have the 0% income for anything up to $12,950. Above that, the next $10,275 is 10%. The next $16,775 is at 12%. You add those numbers together and it equals 40%, or 40,000 for your total income. Gross income of 40,000 minus your standardized deduction and other deductions. So after you process all of the deductions that you have, you are left with your taxable income. If you are single or married, you'll have different tax brackets. People say, well, what if we're a couple? Well, you know, it just depends on the married status there. But you could also do filing separately. The tax code is set to design, or it is set to benefit those people who are married. The type of marriage is unimportant. It's just having that marriage filing jointly is the key. Most people do take the standard deduction, maybe 15 to 20% will follow an itemized deduction based on their particular tax bracket and code. Usually people who are in the highest income bracket will use the itemized tax deductions. The lower the bracket, the more beneficial the standardized deduction would be. And again, here as we're looking at this income of $150,000, you see the standard deduction of $25,010, then the 10% amount, the 12% amount, and the 22% amount. And then you are also seeing here the 150,000 and the 19,222 being the tax, and the difference between the gross and the taxable income. And when you file on with your 1099, you will see those different numbers. And you can use the 1099 to help reduce your taxes. For example, if I'm self-employed, I will report on a Schedule C. And that will calculate one particular tax. There are multiple ways to calculate out your taxes. Another way that you rely on wages and income. And then there's the 1099 MAC, MEC contractors do different type of schedules as well. And the standard deduction is relatively high here. And you can see that this particular income example is at the 22% bracket for a 150,000 income. For the purposes of this training, we're really just going to be focusing on a specific part of this and wanting you to understand the difference in these tax brackets for the 10, 12, 22, et cetera percentages. I do these workshops for other people as well and out in the community, and trying to help people figure out specifically that 22% tax bracket, which is where most people seem to fit. And the tax brackets do change as you go up in income. There are 3 different standardized types to file: single, married jointly. Single being just that, single. You do not have a significant other that you are filing with. Married, filing jointly, meaning filing with your spouse. And head of household. Maybe you are a single parent, you have children in your family, or you're taking care of your own parents, you're taking care of someone else. And that is very important today. And you tend to see that more frequently. Biggest thing is head of household means that you do have dependents who are relying on you. The standardized deduction is automatic, doesn't matter what you do. Everyone does qualify for that standard deduction. And itemized deductions are including all those different things that you could subtract. You need to keep track of all of those on your own and enter them into your tax form. The different expenditures that you may or may not have. Some of you might have student loans. I have myself the education expenses that I can deduct. If you tithe to a church, you can deduct that. You can download an entire schedule, Schedule A, which shows you all of the expenditures that you can deduct in your itemized deduction. The IRS website has a lot of resources that really explain what all of these are. For example, if you're a mechanic, you have different things that you can deduct. And you can interpret these IRS codes in certain ways. The irs.gov website is a great place to go to look into all of those. And the most important thing is you do need to keep your records. You need to keep all of these in a file that you can bring up later to enter into your Schedule A. If you start getting in the habit now, then, and you start entering things into that file and that spreadsheet as the years go on, or as the year goes on, then you're ready to utilize that come tax time. And so it's always a good idea to not only enter those in your spreadsheet, but make sure that you keep all of those receipts so that you know what is covered and what is not, and what you can write off and what you can't. Some people don't have any deductions, or some things cannot be deducted, your medical expenses. If you rent, you do not have a homeowner's deduction. Cars are not deductible. If you just give money as gifts, can't deduct that. There's many people who have never used itemized deductions because of their income. And if you think about the difference in the income that you need to get a benefit out of the itemized deductions versus the standardized deductions, many people just follow the standardized deductions to save themselves the headache of trying to find all of those receipts. But if you are in the habit of saving those receipts and entering all of those deductions, then when it comes time to fill out your taxes, you have a lot less headache and you're able to focus more on just filling out the forms. And of course, there are all times that you do need to discuss what you're going to be deducting and what you're not, as far as your fiscal health goes.
Here are some examples that itemized deductions may apply. Maybe you are diagnosed with cancer and you have to go to the hospital frequently and your bills are piling up. Also, there's an ambulance ride that will cost a lot. Insurance only covers so much. Maybe you are out of the country and have a medical emergency. Maybe you also have to take out a second mortgage to pay for your home or refinance your home. Sometimes if you have a retirement account, you have to take that money to take care of a second home mortgage. Maybe you give tithe to your church regularly and it totals up over a certain amount, this can become part of your strategic plan for itemized deductions. Also, it's important to prepare for any medical emergencies that might come up. Generally, we see people who have high expenditures related to their home or property, also expenses for college or education. Also, there are people who regularly give to their church. Generally speaking, you will benefit as long as you are keeping record of all of your transactions and your expenditures. Here are some examples of two different people and two different life situations. The first person in the orange box follows a standardized deduction. At first, they have an income between $12,950 and $45,000. They fall into the 10% tax bracket. And in the end, they owe $3,640 tax. This is someone who doesn't have any expenses or any deductions that would be recorded. Now, if there was a dependent, this past year, there was an increase in the child benefit. We're not going to get into that right now. Each situation, individual situation is different. But this first example is someone who is healthy with no dependents. It's important to look at your taxable income, understand your tax bracket, your expenditure, and it will follow that and do your best to reduce your taxable income. Now, this next person has the same income as our first example, but they have quite a large amount of deductions. That means their taxable income is much less. If you notice, their tax bracket is now 12%, but it looks like they owe half. They have the same percentage as our first individual, the single person, but because of their deductions, they seem to be ahead. They owe approximately $1,400 less than the first example, even though they have the same income. Every year, with the amount being reduced, that will benefit in a long run. This second example had a person with a medical emergency. They also had a home mortgage. It works differently between using standardized deductions and itemized deductions. Everyone is eligible for standardized deductions. Depending on your financial need and your adjusted income, you can then decide what will benefit you the most, whether to go for the itemized deductions. Now that we are finished with the discussion about tax brackets, and we've talked about income for a single person or a married person, this credits and deductions is something people have a lot of questions about. And again, the US tax code is thousands of pages long, a very long docket. The US is trying to alleviate nationwide poverty. And with that, they typically offer more incentive programs such as credit. A single person used to have no EIC, earned tax income, but this has changed. With research led by the World Bank, they realized that this would help society, specifically people who are insecure, food insecure, and specifically nutritional benefits. The government wants two things for people, for the population numbers to increase and more people to be in the workforce. So they will provide an incentive for that, specifically a credit for taking care of children and for going to work. And EIC is money to make sure that people have access to food and shelter. Having access to food and nutrition does increase a person's IQ and their ability to succeed and function in society. And that is something that our government is very interested in. Generally, our tax system is progressive. If you earn more, you will pay more. If someone is in poverty, they have access to tax credits. There are also options for stimulus to increase someone's welfare. EITC, you can see we have a diagram on the slide. As you max out your income, EITC will reduce. This year has been different, specifically for daycare. They gave $4,000 for $8,000 in spending. That is significantly high compared to what they did in the past. There have been 3 very large tax credits the past few years. The taxable tax credit means the government is giving money to you. After your income has been processed and your base has been declared. This will explain a lot of different credits available across the nation. Regarding energy, whether it be efficient energy for cars or housing, there is solar for people, available for people to install on their house. Also the ventilation system and the solar and wind energy efficient technologies. There's tax credits available for those. Vehicle tax credits. This is a credit to incentivize specific behavior amongst people that will ultimately affect policy making. There is a strong tax credit given across the country for solar. This is to promote behavior to renovate housing and improve living conditions and energy use. Also, there is subsidized earnings, for example, video phones that are paid through taxes. Most are not available unless you make under a certain income and you balance out to 0. So the available credit is $2,000 and it will be 0, and then it will need to be zeroed out, calculated by your return, your tax return. There's EITC. The refund is where you get money back. However, this will work on reducing the tax that you owe and reducing your income. So moving over to deductions, some of the biggest ones in 2022 are listed here, beginning with an IRA account. Anyone can open an IRA account. This is done individually. Also, you can do this through your workplace. More popular is the 401k retirement account. There's also 401b and 403b. This typically applies to federal employees. The highest deduction for taxable income we have is home mortgages. So mortgage interest, maybe it's 12 or let's say 8, depending on what your interest rate is, up, 8% up to 25% interest. That means it will be applied as a property tax. The highest property taxes are in New York and California. We also have medical taxes or medical deductions, which can be up to 7.5 of your AGI. This list is not exhaustive. If you go to irs.gov, you can see a complete list of the credits and deductions available to you. Also, not all of this applies on an individual basis. There might be some deductions or credits available to an organization that you are a part of. Now is time for us to take a look at a couple of examples. We have a single taxpayer and a married jointly taxpayer. This is a general example to give you a general idea of how these tax situations might look. We'll start off here for our first example. It is reduced to 0, tax owed, as you can see. This might be realistic, maybe not. This is an illustration. This is a good way to see if you have a good understanding and control of your tax refund. This person earns $45,000 yearly, has the standard tax deduction of $12,950, and is left with a $32,050 taxable income. Ultimately, they owe $3,640 in taxes. Where we can look at the next example of the standard deduction for the $32,000 taxable income with the IRA deduction. Another more complex example is following the itemized deduction. This one is using a 401k and the taxes owed is 0. Is this possible? Yes. There is a big discussion about how much can be deducted. If it's deducted to 0, taxes owed, this will really depend on what withholding you are signed up for. If you don't have any tax withholding on your paycheck, that means no money is coming out of your paycheck going towards taxes. That will affect whether you get a return or if you owe money. So this person has money being withheld out of their income and ultimately does not owe any taxes once they owe any money once they file their taxes. Let's move on to our second example with a married filer. This is a couple. It's one filing. It's the same yellow example or a situation that we have highlighted in yellow. We can see a difference of approximately $10,000. And the goal of the accountant is to reduce the taxable income. If we look at the white box and what is highlighted in yellow, we can see that they use all of their deductions as itemized deductions. This could be because they have property taxes, medical bills, or other various expenditures needing to be accounted for. Maybe they also have tax credits for buying an electric car or solar panels. Both are maxed out. They have maxed out their 401k contributions. And this is possible. Now, as you can see, this has a significant deduction. Before, the tax income was a much higher number. So it went from 16,000 to 8,000 of how much is owed. So that's quite different. You can adjust this without going into worrying about other income, investments, property, taxes. There's more situations out there that might apply to you. It really depends on your tax bracket, what deductions you have, what credits you qualify for. And this is showing the difference between itemized and standard deductions.
I just want to summarize now the credits and deductions that we've gone over. It's always better to put a little money away every month to be prepared for this. And of course, we understand the taxes will be usually do go up. So you can put a little bit more away every month just to be prepared for when the time comes to make your check or your taxes. But you can see our 3 different examples here of how people have invested their money and broken that out to cover the taxes. Finishing up with our 3 key principles. Most important is lower your taxable income. Use those deductions. Understand your credits. Are you going to be married? Are you going to have children, etc.? Look at all of those things to determine what credits are available for you. Think about how you want to invest your income and what you're going to use your money for. The 3rd is decide on your outcome. Learn how to reduce your tax. Learn how to take advantage of your state codes. Know which states are high tax states and which states are not. When you fill out your 1040 tax forms, do you know what each and every one of those lines mean? Make sure that you learn that and pay attention to what you find on the internet. Once again, as I've said, the irs.gov website has full of resources for your use. And I guess really that's what I've got.
So many thanks to you, Joshua. Yes, we do have some questions. within our Q&A. First, I do want to say thank you so much for the information you provided to us. And if any of you are unsure, like Joshua said, you can contact him, the professional, go to the IRS website. Also, you can contact another professional, but Joshua does have his own business called Def Tax that you can reach out to. Now let's begin with questions.
Yes, bring them on.
Our first question is, do you have any recommendations of tax code books that are deaf friendly or ASL friendly and ways to reduce our tax income?
Really, it's about education. I spend a lot of time on the internet looking at different websites. I think there's an IRS and ASL. If you just search that, there are a lot of different options that come up. And then also just read. And if you just, that's one of the things that I do when I meet with people is just go over stuff and explain it in ASL, what I have read, but the irs.gov website really is an awesome resource.
Fantastic, thank you. Our next question is, what is taxable income?
Taxable income is the income which is remaining after your deductions. When you get your paycheck every 2 weeks, that will be based on your W-2. And if you say that it's 4,000 AGI, then that is converted to your gross income. Once you take that either standard or itemized deduction, it's what's left. So whatever your income is, it is after you take your deductions, which is what becomes taxable. And that's the reason that we emphasize the taxable income, is to maximize those deductions.
Great, I hope that answers that question. We also have a rather large question that I will do my best to summarize. This person says that they received a traditional IRA as a part of an inheritance. They are only allowed to maintain that account for a total of 10 years. And this is because of the Secure Act that was signed in 2019. The account must be zeroed out by 10 years or else they will have a 50% penalty on distributions. They plan to do a partial distribution, 1/10 of the entire amount every year, to drain the account gradually. The annual distribution from that IRA account, combined with capital gains and interest dividends from various mutual funds in the taxable accounts, which will produce a hefty tax bill every year. Unfortunately, all mutual fund holdings do not have exchange traded funds, ETFs, to move into to avoid capital gains. The question is, do you have any advice on how to minimize or reduce annual taxes?
Well, yeah, as a professional, I'd be more than willing to sit down and talk with you, and because that is a very individualized situation, and you got into a lot of your plans, which I think is great. It just, there are other options that you may not be available or may not be aware of. And some people think it happens sometimes because parents don't plan appropriately, and then the children get hit with the tax bill later. So it's always important to plan those things out and sit down and talk things over when someone has passed away to really determine the best plan of attack to reduce those taxes. It usually requires some research and looking around to find other options for improving the outcome.
Okay, thank you. This is another great question. What about if you are a renter, so someone who pays a monthly rent? Are there any good ways to save if they're single, over 65, and working as well?
Yeah, to save is tough. Maybe you're on a set income. Most states have renters credits, but they're not really much, and they vary from state to state, maybe $40, $80 or so a month. Minnesota has a larger credit for renters, but it does have a qualifying income that goes with them. And they also get more of that from the landlords, but it frequently is a minimum tax credit. Because if you are the owner, then of course you have to pay for the maintenance and the mortgage and all the rest of it. So that's kind of balanced out in the taxes.
Another question is, what do you know about different deductions if someone is working from home during the pandemic? So deductions for office, heating, electricity.
Great question. Unfortunately, it's a little complicated. A lot of people try to take advantage of that. I know that I can deduct some of my home expenses as a home office, but unfortunately you can't deduct everything. So I know that a lot of people have shifted to working from home. And you have to think about this sometimes as an educational expense. And so you just have to look into those opportunities as they are there, but you cannot deduct the entire thing.
Great, thank you. Another great question. Typically, taxes paid towards automobiles or property for tax filing. Where can this person find their county and school tax information?
Most municipalities have a website, and you can type in your address, your home address, and see what those county and school taxes would be.
I've done that myself too, actually. Yeah. So we have two more questions. Our first one is, why did Congress reshape the code? So the new tax reform law that was 2018 to 2023. Is it now not good to do itemized deductions?
That's correct. They were trying to make it a little more equitable. The tax code as it was really impacting the median incomes. And so they were trying to adjust that to make it less complex. A lot of people were some people were deducting a whole lot more and therefore reporting less, or were missing opportunities because they were not reporting them. And so they've changed this to try to simplify the tax code. And they frequently and repeatedly over time have changed these tax codes to try to simplify them. They usually make small and incidental changes over time.
All right, our last question. What is the difference between ETF and MF?
Oh, that's a great question. It's a little different from what we've been answering now. MF mutual funds came about in the 70s. When people who knew a lot about what was going on would investigate and figure out different companies that they could invest in simultaneously. So those were a newer concept in the 70s. And the mutual funds are where they would do this research by looking and seeing what was being paid into the system by the CEOs and the people that worked there. And then, probably 2004, 2005, up until 2020s, they started making some other adjustments as people are looking into all of these different options and trying to figure out what was the best place to put money. They got away with many of these mutual funds just to try to clean things up as people were investing more in the individual units. And of course, as we know, that making those investments can be a little bit more expensive. I myself invest in the other funds, not the mutual funds, but they can do the automatic deductions. They can include things that your hotel, your clothing, your all of these other things can also be deducted in certain cases. And so that's why people might invest in these different accounts and funds.
Okay, we did have one other question come in. Things that you purchase for work, are these tax write-offs?
If you think about it as a uniform, okay, then you could write it off. But for me, what I have on now, it would not be considered uniform. Therefore, it's not deductible. But think about people who work in the medical industry, they have scrubs, or if you work at a gym and you have to have certain workout clothes, then maybe, because that would be considered a uniform. But if I just go to work out, those clothes, no. If I work in an environment where I need to have steel-toed shoes, those shoes would be able to be deducted.
Great. Well, thank you so much for your time and sharing your knowledge with the NTID RIT community. Again, if anyone is looking for tax advice, please reach out to Joshua. And thank you everyone for your time. I hope you have a great rest of your week and stay safe. Bye everyone, and thank you.